over the exam for fiscal policy. This is part one. First off, what's the millionaire method? That's saving and investing for 40 years. 40 years. You save $40 per week and invest it at 10%. You'll have over $1 million. Good luck. Diversified portfolio is how you get the 10%. $40 a week, you work and earn a little bit more than you spend. Spend a little less than you make, and that's where the $40 comes from. You live your life for 40 years and let your money do what it can for you, what it should for you. Earn more money. Okay, there's different words for tax systems: proportional, progressive, and another one is regressive. The answers to determine which ones it is, you look at a percentage. We have a person here who makes $10,000, a different person makes $100,000. Under tax system A, one pays $1,000, the other one pays $10,000. This is what we would call a proportional income tax. Under tax system B, one pays $1,000, the other one pays $5,000. Well, $1,000 is 10% of this person's income. $5,000 is only 5% of that person's income, so we would say that's regressive. 1,000 and 11,000, that means X is paying 10% tax, Z is paying 11% tax. This is what we mean when we call a tax system progressive. There's a higher rate paid by those who have the higher income. When both are paying the same amount, but they have different incomes, and the one who has a lower income is paying a higher percentage of their income in taxes, tax system D is also regressive. Under this one, the progressive tax, therefore, same question, it's this one. And under question 3, the tax term that best describes student activity fees, where everyone pays the same amount, is very much like tax system D up there. The fee is the same, even though everyone's income is different, so that would be a regressive tax as well. Now in these next questions, we're looking at Melanie, who is a full-time college student, single tax filing status. She has a child, and she works weekends delivering takeout for Sushi Express. She is trying to maximize her refund, and she would do that by filing the Earned Income Tax Credit, which she's eligible for, and the Americans Opportunities Tax Credit. Both of these credits are refundable, meaning that even though she doesn't have to pay taxes because of her income situation, she would be able to receive large refunds both from the Earned Income Tax Credit and the Americans Opportunities Tax Credit. These other things that she could do would save her on taxes, would be good things to do, but none of them match up to the tax savings or the effect of the Earned Income Tax Credit and the American Opportunities Tax Credit. I have that question on there because most of my students would be eligible for these things, and I think that you should definitely, when you file your taxes, consider filing both the form for this and the form for this to maximize your refund. Bruno, on the other hand, is a different situation. He's a full-time student. He's working a job. He has a child living with him as well, but he has chosen to break the law. He's lying about how much he earns, and that's what we call tax evasion. Interestingly enough, it's tax evasion whether you are lying about it the way most people do who are tax evading. They have income that they don't report. In this case, it's tax evasion because he's lying about it by inflating the amount of his tips in order to earn more for his Earned Income Tax Credit. The Earned Income Tax Credit has a sort of payoff that looks like a plateau. The amount of money you receive in the Earned Income Tax Credit depends on your wages. If you make a very large amount in wages, then you earn nothing for the Earned Income Tax Credit. But if you earn nothing in wages, you also earn nothing for your Earned Income Tax Credit. But if you earn a little bit more, a little bit more, a little bit more, then you get a little bit more until you are in a region where the Earned Income Tax credit is the same for everyone of a certain wage range. And if you make above that, they phase it out. It's a phase out. Next one, Laffer curve. We have a couple questions on the Laffer curve in this review. The relationship between tax rates and tax revenues is this. As tax rates increase, tax revenues first increase and then they decrease. Part of the income tax system allows for wealth redistribution. Some programs, like the earned income tax credit, pay working people additional dollars through the tax system. It is a refundable credit, meaning even those without tax liability may collect it. It is an example of a negative income tax. The following markets represented by the graph below. Tax rates are along the horizontal axis, and corresponding tax revenues are indicated on the vertical axis. So we could just take a look at this and see these graphs that are set up here. That rate corresponds with that amount of revenue. The way to maximize revenue would be to be at this tax rate. Their tax rate is too low. This one, the tax rate is especially low. Here, the tax rate is too high. When the tax rate is too high, you also don't maximize tax revenue. Here, it's just right. Okay. So, the current tax rate is indicated by the arrows. Which market has the potential for the greatest increase in tax revenue by increasing the tax rate? So, this one, we don't want to increase the tax rate. We want to leave it right where it is. Here, we certainly don't want to increase the tax rate because it's already too high. This one, we want to increase the tax rate from here over to here. So, we want to have the most potential for gain here. This one, we would make a small adjustment to increase tax revenue a little bit. So, the correct answer to that one is what's true regarding the relationship between owning a home and income taxes? True or false? Many homeowners choose to itemize their deductions rather than take the standard deduction. Yeah, that's good tax planning, so that's true. Most home mortgage interest deductions correlate with income. That's also true. People with high incomes borrow high amounts of money to buy expensive homes, and they're the ones that benefit the most from the home mortgage interest deduction. People of moderate income or people who borrow small amounts of money to borrow their home can still take the home mortgage interest deduction, but it doesn't have as significant amount of tax savings. So this deduction makes our tax system less progressive, which is true, and the home interest deduction increases house prices, which makes sense, right? If buying an expensive home is a tax advantage, then it increases, it incentivizes or subsidizes the sale of expensive homes. So homes are artificially more expensive than they need to be. Which of these is true regarding the cash for clunkers? Well, cash for clunkers was where they were trading in high fuel-consuming older cars and getting a tax credit to buy a more fuel-efficient car. That was cash for clunkers. Example of fiscal policy. And even though people are naturally incentivized to do that, people like to buy new cars. They don't need the government program to do it. So this would be false. There were actually natural incentives in existence without the government program to do this. It was an unsuccessful environmental program. No, it had some moderate success. We can't say it was a complete failure in that regard. It was more beneficial for imported auto manufacturers than it was for domestic auto manufacturers. Yeah, that's true. It did not impact the used car market. That's false. It was a program that helped everyone equally. That's false. So, as it happened, cash for clunkers was a way that Congress, the administration, paid Americans to buy fuel-efficient cars, and many times they would trade in their American-made Pontiac to get a Japanese-made Prius, for instance. Subsidy to foreign autos. When Congress passed a luxury tax on new domestic yachts, it was projected to raise much-needed tax revenue for the wealthy for important government programs. What actually happened after the yacht tax was passed was that it crippled the U.S. yacht industry. How can evaluating deadweight loss help in creating efficient tax policy? Well, efficiency is what we're looking at for both 15 and 16. We're looking to try to get more for less, or if necessary, just to get the same amount for less, or to get more for the same amount would be another way. Now, in this case, we're looking at a cost in the case of deadweight loss, and the revenue in the term of the benefit of the tax. So if it causes more deadweight loss than tax revenue, then the cost is greater than the benefit, and that is not a good efficient tax. If the tax causes less deadweight loss than tax revenue, then the tax is efficient. That's true. Here we have the cost is less than the benefit, so that's efficient. Let's just rule out the other ones. If tax revenue is used to help people, then it is an efficient tax. No, that's maybe that's spending, not tax, for one thing, how it's used to help people. And all taxes or all government programs help somebody. So if you can't just decide whether a program is good or bad or efficient or not, based on whether it helps anybody. You want to evaluate it on its efficiency as far as its that goes. So that's not it. If a tax causes deadweight loss than tax revenue, then the tax is inefficient. Again, less deadweight loss than tax revenue causes less deadweight loss than tax revenue, and the tax is inefficient. Okay, so this is false, because even though the cost is less than the benefits here, that makes it efficient, not inefficient. So that's the key word that makes it false. How can the efficiency of a spending program, right here was tax or spending, suboptimal programs can become more efficient by using less resources for the same outcomes. That's true. Suboptimal programs can become less efficient by using less resources for the same outcome. Nope, that would be efficient, so that's a false statement. Suboptimal programs can become more efficient by using more resources for the same outcome. No, use more resources to get the same outcome? Of course, that's false.